Correspondent Peter Ryan. Peter, what are you expecting? What factors will the Reserve Bank be looking at here?
Well, hi Ruby. Look, I think we're probably feeling a little bit of unusual calm here at the moment. I guess if the cash rate stays on hold at 4.1%, that would be 5 months in a row where the RBA's cash rate hasn't moved after those 12 rate rises since May last year. But that's not to say that Michelle Bullock's first meeting as RBA Governor will be a calm one or an easy one, because there are some pretty big issues like the big rise in petrol prices over the last month, which looks like being sustained with Brent crude, the global benchmark, heading towards $100 a barrel, and monthly inflation on the headline rate ticking a bit higher in the August reading, although the underlying rate was a little bit lower actually. But I think, as Alicia was saying, this will be pretty much wait and see, but no doubt that Michelle Bullock will be wanting to stamp her authority on the RBA board, put her stamp on this decision, but I don't think we'll be seeing any change this afternoon.
And just zooming out a little bit, how is our economy tracking overall at the moment?
Well, we're starting to see the impact of those 12 rate rises we had since May last year starting to work their way into the economy. It could take months before the full impact's there, but yes, the economy is slowing. Treasury and the Reserve Bank's forecasts see the economy pretty much grinding to about growth of 1.5% by the end of the year, and that's been backed by the OECD and the International Monetary Fund. But it's still growth, but the idea of those rate rises is to slow the economy, to stop people spending, and anyone listening to this will know that that is having an impact, particularly if your mortgage repayment has really surged over the last year.
And what impact are overseas conditions having on the Australian economy?
Well, as I often say, Australia is a bit like a cork bobbing around in an ocean. We're knocked around by global factors. The war in Ukraine, don't forget that. What's happening in the United States, the Federal Reserve looks like raising interest rates on its own too. Also risks about a US government shutdown, which have been temporarily averted. So there are some big issues. The oil price, for example, really something for the Reserve Bank to consider, and as we've seen in the last few meetings, it hasn't been a slam dunk, we won't raise rates. There's been debate and discussion about whether or not to move rates higher, because the idea is that if you see inflation moving higher, if you don't move earlier, as Philip Lowe, Michelle Bullock's predecessor, said, you're only going to have to move harder later, so we'll have to wait and see.
And you mentioned Michelle Bullock there. What impact is her appointment likely to have on today's announcements?
Oh, look, obviously closely watched. So when we get the statement that goes with this decision this afternoon, we'll be looking for any subtle changes that might be in Michelle Bullock's own language and the way that she talks about the inflation risk. And other issues as well. You know, of course we've got the oil price, we've got rising real estate prices rebounding, particularly in Sydney. Clearly a big concern
Peter,
for the
I'll
Reserve Bank.
interrupt you just there because we've got the decision just in. Alicia, take us through it.
It is as expected. The RBA has kept the cash rate at 4.1% for the fourth month in a row, the month of October. No surprises from Michelle Bullock's first meeting, and standing by to talk us through this is Eleanor Creagh, senior economist at PropTrack, and you can see there the trajectory of interest rates rising 12 times since May last year, but flattening out over the last 4 months. They've been on hold since July this year at 4.1%. So let's bring in Eleanor Creagh now. Eleanor Creagh, no surprises, of course. Do you think we're at the peak of interest rates, or do you think there might be one more?
I think it's looking more and more likely that the cash rate has put in its peak for this tightening cycle. We know that, we're still yet to really feel that full impact of all that substantial 400 basis points in tightening that has been delivered since May last year. Consumer spending is already slowing quite markedly, and economic activity and inflation are both expected to continue to slow over the months ahead, with the unemployment rate also expected to increase as well. So I think as a result, we've probably put the peak in for this tightening cycle. And I think with the Reserve Bank now remaining on hold for the last 4 months in a row, that is becoming a more likely possibility or eventuality.
What do you think the next focal point for the RBA will be when it comes to anything that moves the needle here? Will it be the third quarter inflation data at the end of this month that's due?
I think that's certainly going to be the big one, right? So when we look at kind of whether interest rates have peaked, it is going to be, I think, or it would have to be a substantial change in the disinflationary outlook that would cause them to continue raising interest rates from here. So certainly that third quarter inflation read is going to be all important. And I think inflation reads thereafter as well.
Now, the idea that interest rates will be higher for longer is gaining traction. I mean, many economists have been pushing out their forecast for rate cuts until at least mid to late 2024. What's your view about when we could see a rate cut if we are indeed at the peak?
Yeah, I think looking ahead, it's pretty hard to forecast at the moment when interest rates are going to start being cut because we're certainly not at that point yet. You know, although we are expecting inflation to continue moving lower in the months ahead, it still remains well above the Reserve Bank's 2 to 3% target range. And I think we're going to have to see substantial traction in terms of inflation returning to target before we're going to be able to put rate cuts on the near horizon. So it's looking like with the way the economy is tracking at the moment, that could be some point in the second half of 2024. But I think there's still a substantial degree of uncertainty with respect to those kind of long range forecasts. And at the moment, we are expecting that interest rates are going to be on hold at this higher level for a continued period of time.
And Michelle Bullock today has reiterated the RBA's line that has been in the statement for many months now, that some further tightening of policy may be required to ensure inflation returns to target in a reasonable time frame, certainly leaving the door open for another increase.
Yeah, I mean, certainly leaving the door open there. And I think that is prudent, given that, you know, there is still a large degree of uncertainty as to how, I guess, the inflation outlook is truly going to materialize. We clearly saw that monthly inflation read for August picking up, although when we exclude those volatile items like the price of petrol, the continued trend in underlying inflation does show a continued subsiding pressure there. But certainly, you know, there is a degree of uncertainty, and I think it is prudent for the RBA to maintain that the door would be open for further tightening if necessary. But I think the way we're tracking, and certainly with that full impact of all the tightening already been delivered, yet to be felt, we are likely to see inflation continuing to head lower, and it's probably more likely than not that interest rates have peaked and are going to remain on hold for the foreseeable future.
And of course, the property market is in focus. I mean, yesterday we saw housing data out from CoreLogic show that home prices in capital cities have continued to rise, and they're very close to record levels in some of the major capitals. I mean, keeping rates on hold, is there a risk here that the RBA will just inspire confidence in buyers and sellers heading into the spring season and see those prices rise further?
So we're certainly expecting that home prices are going to continue to lift. So according to the PropTrack Home Price Index that we measure, national home prices have already regained all of 2022's fast falls and are sitting at a fresh record high in September, with home prices continuing to lift as the spring selling season has kicked off. So national home prices lifting a further 0.35% month on month, according to the PropTrack Home Price Index. And certainly we're expecting that home prices are going to continue to rise as the spring selling season plays out. You know, we do have, as you quite rightly mentioned, interest rates now remaining on hold for that fourth consecutive month. We've also seen 9 consecutive months now of positive home price growth, and market conditions are continuing to improve. We've also got that strong rebound in net overseas migration, population growth, and of course what are very tight rental markets in most capital cities at the moment, which I think are probably incentivizing those with the means to do so, of course, to maybe enter to the market to buy a little bit sooner than they otherwise would have. And all of those factors are contributing to stronger home buying demand. And against a shortage of new home builds, we're certainly expecting that home prices are going to continue to rise, and that we're going to see more markets reclaiming all of 2022's fast falls to sit at fresh highs.
Eleanor Cray, appreciate your time. Thank you.
Thanks for having me.
So, Ruby, with interest rates at 12-year highs, even being on hold for the fourth month in a row, it does offer some confidence to those who would like to be buying a home and perhaps those who are already paying a mortgage. But there's still not a huge amount of relief in sight when it comes to cuts well until next year.
Thank you so much, Alicia. And let's go back to Peter Ryan now, who I rudely interrupted before. Peter, you've been looking over that statement from the Reserve Bank. How is it seeing the economy, and is there anything specific in there from Michelle Bullock?
Well, Ruby, I think to sum it up, to use the saying, this is a hawkish pause, yet another one, because as Alicia and Eleanor said there, the language is pretty much the same as Philip Lowe had in his last 12 statements or so, that the Reserve Bank will be keeping a very close eye on inflation, that more tightening might be necessary, that they will act, do whatever it takes if they see inflation rising. And the reason for this is that they don't want to be perceived as taking their foot off the inflation pedal or sending any signal that the war with inflation is over. So rates on hold, waiting for incoming data. We'll be having fresh inflation data pretty soon. Any other piece of economic data will be very, very important as the Reserve Bank formulates what to do. Some economists think that there's still a chance of a rate rise on Melbourne Cup Day, which I know wouldn't be very popular at all, but the Reserve Bank does have form on this, so there is still the chance, I would say an outside chance, of a rate rise over the next couple of months, maybe November or December.
Peter, thank you so much. And finally, let's return to Alicia Barry. Alicia, much reaction from the market. Were they expecting this?
It was certainly expected. Heading into this decision, there was a 12.5% chance of a rate hike priced in, which is pretty low in the context of, I guess, market forecasts. So given that, the Australian dollar is sitting pretty much where it was at 63.4 US cents, and the market itself hasn't moved all that much. It was down 1.3% heading into this decision. It's now down 1.1% or just over. So a fairly muted reaction from both the dollar and the financial markets there.
And that's where we'll leave our rates coverage. Alicia Barry and Peter Ryan, thanks to you both.